The rise of American debt, how it will impact our future. There are significant problems and repercussions for the American economy and society as a whole from the nation's mounting debt. Concerns regarding fiscal flexibility, social programs, economic growth, international competitiveness, and generational equity have gained traction as debt levels reach all-time highs in relation to GDP. What impact might the United States mounting debt have on our future? We'll look at a few of its facets today. Number 12. Economic growth and stability. Debt accumulation can obstruct stability and economic growth in a number of ways. First of all, a sizable amount of government revenue that would otherwise be allocated to vital public investments is diverted toward debt servicing or paying interest on the debt. Infrastructure, healthcare, education, and research and development are all supported by these funds and are essential for promoting long-term economic productivity and competitiveness. Spending by the government that puts paying down debt before making profitable investments can stifle economic expansion as a whole. Furthermore, having a lot of debt may make borrowing more expensive. Investors may demand higher interest rates if they believe that the nation's increasing debt levels make owning U.S. debt more risky. Higher borrowing costs for the government, as well as for people and businesses, could arise from this. Consequently, there may be a decline in consumer spending and private sector investment, two significant drivers of economic activity. Number 11. Interest rates and inflation. Interest rates and the dynamics of inflation may be impacted by the increase in U.S. debt. The government competes with other borrowers for available funds in the financial markets when it issues more debt to finance spending. An increase in interest rates could result from this competition, which would have an impact on corporate borrowing costs as well as mortgage rates. An increase in interest rates might deter businesses and consumers from spending, which would obstruct economic growth. Furthermore, there's a chance that increasing debt payments will intensify inflationary pressures. Demand pull inflation may happen if the government spends excessive amounts of money on deficit programs without also raising the potential for productivity growth in the economy. This is what happens when the demand for products and services outpaces the supply. Due to persistent budget deficits and growing debt levels, inflation has been relatively low recently, but it may still have a detrimental effect on real incomes and household purchasing power in the future. Number 10. Government spending priorities. Growing debt levels frequently force tough decisions about government spending priorities. Governments may find that they have to pay interest on a larger portion of their budgets rather than spending them on essential public goods and services as debt servicing costs rise. As a result, financing for initiatives related to environmental protection, education and skill building, healthcare provision, social safety nets, and infrastructure maintenance and development may be lowered. Government budgets are further strained by demographic trends like an aging population and rising healthcare costs. Governments may find it difficult to reconcile meeting these growing demands with debt repayment if they fail to implement sustainable fiscal policies. Programs that promote social mobility and inclusive economic growth may be hampered by this, and socioeconomic gaps may get worse. Number 9. International standing and geopolitical influence. A country's debt load can affect its international standing and geopolitical influence. If a nation has high debt levels in relation to its GDP, international creditors and investors may doubt its capacity to manage its finances and pay back its debts. This could have an impact on the nation's creditworthiness and currency confidence, which could result in higher borrowing costs and a worse reputation in international financial markets. From a geopolitical standpoint, a nation burdened with a lot of debt may find it difficult to react quickly enough to external economic challenges or shocks. It may therefore be less able to exert influence over international agreements and negotiations and project power. A country's ability to maintain economic stability and geopolitical dominance in the international arena depends on its ability to maintain sustainable debt levels and fiscal restraint. Number 8. Generational impact. The U.S. debt crisis will have a significant effect on future generations. As current debt levels rise, future generations may inherit a fiscal environment characterized by higher taxes, fewer public services, and fewer economic opportunities. High debt levels limit the ability of policymakers to invest in the infrastructure, technology, and education that are necessary to foster innovation, productivity growth, and global competitiveness. In addition, the cost of debt repayment will fall on future taxpayers, potentially leading to generational inequality. Governments that place a higher priority on paying off debt than making investments in the welfare of their citizens in the future may also raise taxes or limit younger generations' access to public services. It is imperative to achieve equilibrium between immediate financial obligations and enduring sustainability objectives in order to tackle the escalating debt and ensure that forthcoming generations inherit a resilient and flourishing economy. Number 7. Policy flexibility and crisis preparedness. The tendency to overspend can make it more difficult for decision makers to react quickly and effectively to unanticipated crises or downturns in the economy. Governments typically use fiscal stimulus measures like higher government spending or tax breaks to boost aggregate demand and aid in economic recovery during economic downturns or financial instability. Nevertheless, governments may not have much money in their budgets to carry out these stimulus plans if they are already highly indebted. This might make economic downturns last longer and make vulnerable populations' social and financial struggles worse. Inadequate fiscal buffers can make a nation more susceptible to external shocks like natural disasters or global financial crises and make it more difficult for that nation to respond effectively and quickly to them. Number 6. Long-term sustainability and fiscal discipline. Due to the growing national debt of the United States, sustainable budgetary practices and long-term fiscal restraint are imperative. Finding a balance between increasing tax revenue and wisely allocating funds for social welfare, economic expansion, and environmental sustainability is necessary to achieve sustainable debt management. Achieving fiscal sustainability requires putting structural changes into place to slow the growth of spending, increase revenue, and enhance the effectiveness of public spending. This entails improving tax compliance, cutting back on unnecessary spending, restructuring entitlement programs, and stimulating the economy by making changes to regulations and investing in human resources. Furthermore, preserving public trust in the government's fiscal responsibility is essential to upholding economic stability, and encouraging investor confidence. Reducing the effects of debt requires transparent fiscal policies, attainable budgetary goals, and efficient debt management techniques. Effective debt management plans, realistic budgetary goals, and open fiscal policies are critical to lowering the risks brought on by growing debt levels and guaranteeing the long-term prosperity of all Americans. Number 5. Income inequality and social cohesion. Furthermore, maintaining economic stability and fostering investor confidence depend on maintaining public confidence in the government's fiscal responsibility. Transparent fiscal policies, realistic budgetary objectives, and effective debt management strategies are necessary to lessen the effects of debt. The long-term prosperity of all Americans is contingent upon the implementation of open fiscal policies, realistic budgetary goals, and effective debt management plans, which together reduce the risks associated with rising debt levels. Number 4. Financial market volatility and risk. The accumulation of debt increases financial market volatility and systemic risks. When there is a large quantity of public debt, the financial markets are more susceptible to shifts in interest rates, credit ratings, and investor mood. Market perceptions of sovereign credit risk can affect bond yields and borrowing costs, which in turn can affect capital flows and decisions about both domestic and foreign investments. A country's debt sustainability worries can cause market sell-offs, currency devaluations, and capital flight in times of economic or geopolitical unrest. This could lead to increased volatility in the financial markets, which could affect asset prices, investor confidence, and retirement savings. It is imperative for policymakers to have transparent and efficient communication channels with debt holders to preserve stable financial markets and reduce the systemic risks that are linked to mounting debt. Number 3. Environmental sustainability and climate resilience. Concerns about environmental sustainability and climate resilience are related to the United States' rising national debt. To combat climate change, large-scale infrastructure investments for renewable energy, environmental preservation, and adaptation plans are required. However, high levels of debt may limit government funding and political will to prioritize these projects. Furthermore, governments may have to shell out large sums of money for disaster relief, medical expenses, and infrastructure maintenance as a result of environmental degradation and climate-related disasters. Excessively high levels of debt make it difficult for the government to deal with these issues, which could endanger attempts to strengthen climate resilience and reduce the long-term damage that environmental degradation does to the economy and society. Number 2. Global competitiveness and trade dynamics. A nation's international competitiveness and trade dynamics may be impacted by high levels of national debt. Spending excessively can result in higher borrowing costs, which raises the cost of capital access and investment in R&D, innovation, and business growth for companies. This could impede technological advancement and productivity growth, lowering the competitiveness of home industries in international markets. Furthermore, foreign investors' perceptions and decisions regarding capital allocation and trade may be influenced by worries about a nation's creditworthiness and fiscal sustainability. For a heavily indebted country, maintaining a stable exchange rate, negotiating favorable trade agreements, and attracting foreign direct investment can be difficult. In an increasingly interconnected global economy, promoting fiscal restraint and advocating for policies that boost economic competitiveness are critical to guaranteeing sustainable growth and prosperity. Number 1. Technological innovation and future investments. Investments in innovative industries and cutting-edge technology. which are crucial for long-term economic growth, may be impacted by the rise in U.S. debt. Pro-innovation regulatory frameworks, entrepreneurship incentives, and government support for research funding are all significant ways that governments foster innovation. However, a high debt load may restrict government investment in these areas, lowering the likelihood of revolutionary discoveries and scientific advances. Furthermore, uncertainty about future fiscal policies and budget priorities may erode the private sector's confidence and investment in cutting-edge technologies. Research and development spending cuts have the potential to impede progress in areas such as artificial intelligence, biotechnology, digital infrastructure, and clean energy. These industries are essential to maintaining global leadership in innovation, increasing productivity, and creating high-caliber jobs. In conclusion, even though there are many risks and challenges associated with the growing American debt, solving these problems calls for an all-encompassing strategy that incorporates inclusive economic policies, strategic investments, and fiscal restraint. To see more educational videos, subscribe to our channel and leave a comment below if you have any suggestions.